So the equity market started 2024 quite strong, with January extending the gains that we saw in November and December. February has been a little more mixed, a little more nuanced, with some of those Magnificent Seven stocks actually starting to struggle quite a bit. I'm looking at you, Tesla. Here I'm going to talk about the three stocks out of those leading growth names, the Magnificent Seven, that I think are most important to watch here in the second half of the month of February. These are stocks that have gapped higher, and if they hold those support levels, things are pretty good. If they fail to hold those recent gaps, look out below. So here are the three most important growth stocks to watch here in February 2024. So 2024 started pretty strong, with January continuing the gains that we saw in November and December for leading growth stocks. February has been a little bit more mixed. Even with that the case, though, the New York FANG Plus Index, which is sort of the FANG and FANG-like stocks, sort of a Magnificent Seven proxy, along with some other names, up about 12% year to date through the end of this week, compared to the S&P, the NASDAQ 100, both up about 5%. It's over doubling the positive percent return here year to date. Even though a lot of names have struggled here in February, overall the FANG stocks, as labeled by the FANG Plus Index, still holding up quite well. There are three names I think in particular that are key to watch out of that sort of Magnificent Seven type of group. You have the breakdown names, right? The names that have been struggling, like Apple and Tesla. You have names that are continuing to push to new highs, like NVIDIA. But then there are three stocks in the middle which we're going to focus on today. They recently had a price gap, and I think that price gap could be an important market tell to see if those key levels of support are able to hold. Before we get to those charts, here's one more thing I want to tell you about. I'm a technical analyst, which means I spend hours every day looking at hundreds, if not thousands, of charts. But in my own decision-making process, it's not purely technical. I actually spend a decent amount of time looking at fundamental factors that are actually driving companies and empowering them to grow for multiple years going forward. I look at macroeconomic data like the Fed and inflation and interest rates to think about how all those factors might impact those stocks and ETFs that I'm looking at. And I also have learned from spending years working with institutional investors that having a good quantitative model is super important. What a quantitative model does is basically look at the characteristics of successful stocks, looks at all the factors, technical, fundamental, everything, and wraps it into one rating, and then allows you to focus on the best opportunities within a particular set of stocks or ETFs. The good news is, as an individual investor in 2024, you have access to a pretty decent quantitative model through Seeking Alpha. If you go to marketmisbehavior.com/Seeking Alpha, you'll be able to take advantage of their quantitative rating. They actually have a pretty sophisticated quant model that is driving their quant rating. You can then cross-reference what we're talking about on this video, is looking at the charts of leading stocks, looking for big base breakouts and good technical opportunities, but also look to see if the quantitative model from Seeking Alpha supports the upside potential of those names. So go to marketmisbehavior.com/Seeking Alpha to find more information. Usually get a better deal for you. It's an affiliate link, which means it helps me make Market Misbehavior awesome, and we're all happy. So check it out, and let's get back to the charts here. All right, so we're keying in on three stocks, those sort of middle ground names, not the ones that are breaking out like NVIDIA, not sort of the choppy sideways ones like Apple and Alphabet, not the breakdown one like Tesla. We're talking about the other three, right? Meta, Amazon, Netflix. Now, what's consistent about these three, and I have them actually on one sort of bigger chart so we can compare and contrast them, but look how similar the price action is between all three of them. Now, all three of these had a high sort of in the June, July, August timeframe, and I've drawn these lines in a particular place on each chart, but they sort of had this nice rally in the first half of 2023. They all topped out sort of in the summer and then sideways. And I put these green horizontal lines to sort of key in on what I consider sort of a pivot point. A pivot point, in my terminology, is basically a level that has meaning. You often find resistance, support, numerous tests of that level, and it's just a level that has meaning for that particular stock in this particular period. So for Meta, it was the rally to the July peak around 325. We pulled back there in August. We retested almost the same exact level in October. We finally broke above it briefly for about 2 weeks in November, briefly below it in December. So we're sort of rotating around that equilibrium price. And then we finally broke out in December. So again, think about what the market is telling, what the chart is telling you about the sentiment of investors. We're in a bullish phase. where there's broad accumulation. We're in a sideways equilibrium phase, or what's called a basing pattern, a sideways pattern of consistent highs and consistent lows. Okay, I have a nice support level around 280 that holds pretty much through that entire period. Then we have this period, which I would argue is sort of an equilibrium, right? Market's saying the stock is worth around 325, and we're just kind of overshooting and undershooting that pivot point. Then finally something changes in December. We leave that in the rearview mirror for good, or at least for now, and we rotate higher. Then we'll get to the gap here in a second with Amazon, which is the middle panel. Similar run. You had a little gap here, which ended up being what's called an exhaustion gap in August, which is after a big move. You have one more jump higher, but then no additional buyers come in. Then look how we sort of stalled out around that level. That's around 143. That was the high in August. September, I would consider a retest of that level. Similar to what we saw with Meta, here with Amazon, we sort of, again, equilibrium trade 6 weeks right around that level. We finally broke out, retested it, and then broke to new swing highs. Now, this one, Netflix, is a little bit different. I'm thinking of the June high as sort of a key moment because you can see it lines up with some of these subsequent levels pretty well. And I'm seeing this July sort of blow off high as a failed attempt to get above that resistance, which was around 450. We then traded below, and then look how we tested that level a number of times, traded down, gapped higher, then we sort of break above and retest from below, and then finally we break out. Now, I have these pink shaded areas on all three of these stocks. And this is the most recent price gap. Every one of these from mid-January to early February gapped higher, right? This is sort of an earnings kind of gap here. So you have Meta going from 405 up to 450 overnight. Here we have Amazon 160 up to 167. And then here we have Netflix gapping above 500, which was pretty meaningful, and gapping up to around 535, we'll call it, and trading higher. Now, all three of these currently remain above that gap level, but not by much. You can see that Meta, of course, has made a new 52-week high since, but it really hasn't gone anywhere, right? After that gap higher and that initial move, we've sort of been chopping around this period. For the last 2 weeks, it's been sideways. There have been no additional buyers coming in, and I can say that because if additional buyers were coming in here, the price would have done that. It would have done an SMCI and just gone vertical because people would have been thrilled buying more and more Meta at those elevated levels. That's not what we're seeing. You're seeing that initial gap higher, but then an exhaustion point where no additional buyers are coming in. See a similar pattern with Amazon. The gap higher, no additional demand. We briefly tried to break above it and failed, and now we're again sitting at the top end of that price cap. Probably the most constructive has been Netflix because it's actually remained away from that gap price. The upper end of the gap's around 535 to 540. That's where we gapped up. We did see some initial buying over a couple days. Then again, we remained sideways. The end of this week, by the way, out of all these charts, probably the least constructive. This is called a dark cloud cover candle. We have a big up day, a big down day. We don't get all the way below the previous day, which would be called a bearish engulfing pattern. It's called the dark cloud cover where there's enough of an overlap. But either way, short-term bearish. So I think these three charts are probably the most important. You have those leadership names like NVIDIA, like SMCI, the Costco, these stocks that have just had incredible runs. And I can't believe I just grouped Costco in with a bunch of growth stocks, but that's what the chart's telling me. They're similar charts for sure. But you have these names that have gone vertical. And again, it's important to watch this, but I don't think those are the ones to watch for the key signal. And then you have things that have been clearly breaking down, like a Tesla. I don't draw a lot of big market insights from what's happening with Tesla because I think there's a lot of company-specific issues that chart is probably reflecting. But when I look at the charts of Meta, Amazon, and Netflix, it lines up with my concerns about the seasonality. And we talked in a recent video about the Hindenburg-Omen, about the seasonal tendencies, but also some of the negative signs we're seeing, actually quite bearish signs from weakening breadth conditions and a rotation in other parts of the market. But growth stocks like Meta, Amazon, and Netflix so far have been holding their ground. But if they start to go back within this gap range, I would be concerned. That would tell me that at least the bullish trend we've seen in the first 6 weeks of the year is certainly over. If we break below the lower end of the gap, we fill that gap and break lower, and we're not actually able to hold those highs from pre-gap in January. That's where I think this market can get really ugly very, very quickly. So again, the seasonal charts would tell you that February and especially March tend to be quite weak. Something like the Hindenburg firing, which again I put a link in the description below, is a concerning sign about limited upside potential and certainly an elevated risk of downside drift. I think these three charts, Meta, Amazon, Netflix, might be the three to watch to see if these gaps are able to hold. I think the bullish case for the markets here is that these gaps do not get filled, that we hold the upper end of these pink shaded areas and these leading stocks remain at least up in these levels. We failed to hold those gaps. The bearish tell here is as we go into that range, and the real negative sign would be breaking below the lower end of that gap. Those gaps are filled and we break down. That would suggest to me that March is most likely going to be a lot more painful than a lot of investors think. What do you think about these three names, Meta, Amazon, Netflix? Are you a buyer here, yes or no? Drop a comment below and let me know. For Market Misbehavior, I'm Dave Keller. Be well, stay safe, have a good one.